The last assets are intangible assets. If you go back to that definition of an asset, it's something with a probable future economic benefit. It has to be under the company control and as a result of a past transaction. But there are things that we have that you can't touch, but they are things that you can buy and sell, and they're things that have value to the company. And those are intangible. And the closest we've talked about, if we think about our receivables, those are just kind of IOUs where you have the right to receive some money. Those are not quite touchable, that are definitely an asset. What goes in these intangible assets, not the receivables, these still go under current. An intangible asset are things where you have rights to do something, have something. It has to be a legal right. Things that are normally intangibles are patents. I can't really touch that patent, but the fact that I have it gives me the right to use that, and more importantly, the right for others not to use it. So this has some value, but because we're conservative, the value for accounting is the cost to get the patent. Those legal fees and filing fees, those all go into the cost. Copyrights, like they have on your book, it has a value because nobody else can Xerox your book. It's valued at the cost to get the copyright. Trademarks are another one. If you buy the trademark, that's the cost. For example, Google bought Fitbit for the trademark of Fitbit. And when they made that purchase, part of the cost of the purchase went to trademarks account. Your book talks about fishing licenses. You think, what? That's not the fishing license that you buy from the state to go to Carlisle Lake. These fishing licenses is if you watch The Dangerous Catch, I think is the name of it, where these are commercial fishing licenses where those big fishing companies go out and they have the right to fish a certain part of the ocean. And then there's the rights to anything else. If you watch the NFL or baseball, you always hear you cannot show this program without the express written consent of the NFL. That express written consent comes with a price. You have to pay to be able to show those highlights. Another one that we're not going to talk about, but leases. So when you lease your apartment, you have the right to use your apartment. And so that's an intangible asset. A question then is, how about research and development? So I'm trying to develop the new vaccine and for COVID, and I've pumped in millions of dollars of costs to research and development. I'm sure I'm going to come up with a product that I'll be able to get licensed through the FDA. That seems like that has a future economic value. And this is just one where FASB says no. So even though it kind of meets the definition, they say it's not an asset, R&D, you expense as incurred. And the reason is it's too uncertain to book as an asset. So what they're saying is part of the definition that it doesn't meet is the probable. The general rule, if you think about everything that we did as we went through the examples, is you record it at the cost and then you expense over the life. For intangibles, we never have a salvage value. We need to debit an expense just to make your life miserable. We have a special, really long, fancy name for this. This is called amortization expense. And amortization is just a fancy word for a systematic way to write it off. The thing you don't want to call it is depreciation. We depreciate buildings, we amortize intangible. And then the credit is the actual account. And so the other thing that is different is there's no contra account. So when we write it off, we're going to write off the credit, patent, trademark, whatever that is that you're using. The method, there's no such thing as units of production. So this is always just straight line. Period of time, just like our fixed asset, it's how long you think it will be used, not the legal life. That 70-year copyright after you're dead, for most of the stuff we write, nobody cares. A quick little example. On January 1, you spend $50,000 to get the utility patent. On my new invention, this is one from Shark Tank. It's a belt buckle that folds to hold your beverage. The patent is good for 20 years. We believe it will be useful for 5 years before somebody else either knocks you off or nobody cares. On January 1, we're going to debit patent and we're going to do cash. It's just the amount you spend on legal fees, or if you'd buy this patent from another company. That's $50,000. On 12/31, then we're going to reduce our patent and we're going to call it amortization. If you're in England, that's with an S. For 50,000 divided by 5, it's 10,000 a year. And we'll do that for 5 years. And just like depreciation, the whole point is to expense over the period that revenue is generated. We've got one specific intangible that confuses everybody, and that is goodwill. And goodwill does not mean, this is sort of like depreciation, it doesn't mean what you think it means. So get that out of your head. It doesn't mean the goodwill you build up with your customers and how people might like Coke better than Pepsi, or how you take returns very easily so people will come to your company. None of that has to do with goodwill. For financial statements, goodwill only happens if you buy another company. So there's a merger or an acquisition. That's the only time it happens. The goodwill is the extra you paid for the company over the value of the asset. For example, they're paid $66 billion for Monsanto a few years ago. The value of Monsanto's assets was closer to 50 billion. There was 16 billion in goodwill. Just the difference. We paid extra for Monsanto because we wanted it, if we're Bayer. Only comes about if you buy another company and you pay more for it than the fair value of all the assets. When is goodwill capitalized? It's at the time of the purchase, and that's the only time you get it. When is goodwill expensed? This is the one because we assume you bought it and you had the good thought process. So this one has a non-finite life, meaning that you assume if Bayer paid an extra 16 billion, that's going to be true for the rest of eternity. And it probably will get bigger, but we're going to assume it doesn't get less. So goodwill, since it doesn't have a life that we can estimate, goodwill is not expensed, and this makes a lovely multiple choice question. If the value ever goes down, though, it's sort of like land. We impair it. At that point, we'd have a loss.